Hello there. Welcome to your guide, your ultimate guide to moving averages. I hope everybody is doing well. It is late January and trading is ticking over. I have not had any big wins yet in 2024. I have a really good euro pound position open. I opened it on the 3rd of January. It's nearing 150 pips now, which is a lot for that pair. It doesn't sound like much, but for euro pound, it's a good win with a good risk reward. Everything else has been very mediocre. Things will change though. Things will pick up. Stick to the strategy and things start paying off. I do have a bit of a cold, bit of a sore throat. I have my drink here, so please bear with me. I will do my best. It is the season. It's also a storm outside, so you might hear the wind blowing against the house. Okay, moving averages. Explained. I'm going to go through the what, why, and how of moving averages. So what moving averages are, why you should use them, and how to use them when trading Forex. I love moving averages. They are fantastic. I use them on a daily basis, and you should too. By the end of this video, I think you will be using them, and you will grow to love them if you don't already love them. They are a fantastic tool, a fantastic indicator, the most popular indicator, technical indicator when it comes to Forex trading or any trading. Market analysts use them, professional traders use them, retail traders use them. They are fantastic. So what are moving averages? Let's jump right in. The basics of moving averages. As the name suggests, they are an average that moves. So we all know what an average is. If you have a moving average of, say, 25, then what that average will do is take the closing price of the last 25 candles and plot the average. When a new candle closes, it will then use that new candle close, that new closing price of the new candle, the closing price of the new candle, plus the 24 previously, so a new 25 candles, and plot that. A new candle will close. It will then incorporate this closing price, plus the 24 previously, and plot that. So it's moving, the average is moving as the candles close. If you don't know what a Japanese candlestick is, if you don't know what a price chart is, you're probably not ready for this video. Go and find my free course on price action, technical analysis, and then come back. These moving averages are continually plotting averages of, or the average of closing price of Japanese candlesticks. These averages are joined together to create like a wave, a line across your chart. Let me demonstrate this. It might make things a lot easier if I bring up some charts and show you. So where are my charts? Okay, here's MetaTrader. This is a moving average, and this is a moving average of 100. This is taking the last 100 candles, the closing price of those candles, and plotting the average, and continually doing that with each candle close. We have this line, this wave, this thick red line. Let's have a look at my trading view. I have two moving averages here. Let's do the green one. Let's get rid of the red one. So once again, I have this wave, like this line on the chart. This is a moving average. That's the basics of moving averages. They have different settings. So as mentioned already, you could have a moving average of 25. So that's taken the closing price of the last 25 candles. I also showed you a moving average of 100. You can have any setting, any period, any length. They're all different names to describe the same thing. And that is the amount of candles that are being used to calculate the average. So if you have a moving average setting of 7, it's going to take the closing price of the last 7 candles. 21, the last 21 candles. A moving average of 200, it will take the last 200 candles. And these moving averages are based on the time frame that you currently have on your price chart. So if you have a daily chart, daily time frame chart, daily price chart, then the moving average will be based on the closes of those daily candles. If you then jump to a 15-minute chart, it will use the closing price of those 15-minute candles. So it moves with the time frames. It's just like the other indicators, it calculates using the data on the current time frame that you have. Now, there are such things as fast and slow moving averages. A fast moving average is a moving average that has a low period, a low setting, a low length, such as 5, 10, 15, 25. So these are faster moving averages. They're not calculating as much data, and the characteristic of these fast moving averages is they're generally closer to price and a bit more jumpy. Whereas slow moving averages have a higher setting, have a higher length, a higher period, such as 50, 100, 200, 500. These moving averages are generally more smooth and slower and are generally further away from price. So once again, I wish there was a better way of bringing up my charts, but once again, let's have a look at the charts. So my red moving average here is a 100, so that's a slower moving average. And this green one is a 50, so that's a bit faster. So a faster and a slower. You can see that this faster moving average, the green one, stays much closer to the candles, much closer to price than the red one. And we can have a look at some more examples. Let's go to our MetaTrader platform and look at this chart here. So once again, we've got two moving averages. This is a 100, the red one, and the green one is a 50. So the 50 is a faster moving average. The red is a slower. You can see the green is closer to price, whereas the red isn't. Now if you use a moving average of say 10, you'll find that it's not as smooth as these. So these moving averages are less smooth the lower they are. In other words, the faster they are, the less smooth they are, or the slower they are, the more smooth they are. So if we do a moving average, and let's do a moving average of say 10, and we'll do this to be like a navy colour, nice and thick so it stands out. So look at this, this is not as smooth and it's very close to price. This is a very fast moving average. Okay. Let's go back. There are also different moving average types. The most common moving average types are SMA moving averages, that's Sierra Mike Alpha, SMA, and also EMA, Echo Mike Alpha, SMA, EMA. There's hundreds of different types. If you've entered the world of technical indicators, you'll know there's hundreds of different settings, hundreds of different types, hundreds of different indicators, if not thousands. It's the same with moving averages. But the most common moving average types are the SMA and the EMA. The SMA is the moving average I've just explained. It's simply using the last 50 candles, 100 candles, 21 candles, etc. And the S in SMA is simple. Simple moving average, SMA, simple moving average. The EMA also calculates the average using a period setting length that you've set, but it does put more emphasis on the more recent candle closures. So the average is more weighted to recent price data. Now you may be thinking, okay, I now know what a moving average is. I know what the setting is. I know that moving averages can be slower or faster, and there are different types. But what moving averages should I be using? Well, I use the SMA It doesn't really matter if you use an SMA or EMA. There's very little difference. It's down to personal preference. What settings should you be using? Well, if you're looking at higher time frames, such as the 1 hour higher, 1 hour, 4 hour, the daily, the weekly, the monthly, then the moving average settings you should be using are the 50, the 100 and 200. Not necessarily all three, but the 50, 100 and 200, you should be using at least one of them if you're going to use a moving average looking at those higher time frames. There's two main reasons why you should use the 50, the 100 and the 200. The first reason is that's what the professionals use. If you ever watch Bloomberg, if you ever have the opportunity, the privilege to meet with a market analyst, they'll have moving averages on their screen. It's going to be those three, or at least one of those three. And you want to be watching what the professionals are watching. The second reason why you should use one of those settings is they work. They're very useful. I know that because I use them on a daily basis and I see them work on a daily basis. If you're using lower time frames, anything below the 1 hour, 30 minute, 15 minute, 5 minute, 1 minute, if you're crazy. If you're looking at those smaller time frames, then you probably want a smaller moving average. And the most common settings like the 7, the 14 and the 21. 7, 14, 21. Okay. You should now know what a moving average is, what it looks like. Any questions? Use the comment section below. I am here to help you. There's no charge. Just leave a comment. I'll get back to you. If this has been helpful so far, leave a comment below. Like the video. Interact, please. Okay, so why should we use moving averages? What's the whole point of moving averages? Well, I could say, I could ask the same question with regard to any technical indicator, any price action pattern, or even the price chart as a whole. Why do you use a price chart? Why do you look for price action? It's all to do with forecasting direction. You are trying to predict where future price is going to be. Because that is the key to making money, is it not, from any financial market? If you think prices are going to go up, you can take trades and make money from that. If you think prices are going to go down, you can make money from that. So moving averages are all about forecasting future price, future market direction, and they work. So how do we use them? How can we use moving averages when it comes to analysing the Forex market? And there's three main ways: market direction, a change of market direction, and support and resistance. So let's have a look at this market direction. First of all, how do moving averages help us gauge, predict, forecast, know market direction? We do have a bit of movement across the markets. US dollar, Canadian dollars coming down. Let me just check my open position. Okay. Looks like US dollars weakening across the board. I've had a really good couple of days. When I say really good couple of days, it's been mediocre. Today might be a bad day. I'm keeping an eye on things. Okay. So how do moving averages help us with market direction? Well, the direction the moving average is going, so this moving average here is moving up, can help us gauge the trend direction. The moving average is moving up and price is clearly uptrending. So the direction of the moving average can give us the direction of price. And if I scroll back, you'll see this is pretty much the case most of the time. The moving average is coming down now and price is downtrending. It moves up here and price moves up. It's also the same with a sideways market. If I can find one, when a moving average is kind of moving sideways, that can indicate that the price action is sideways, that price is consolidating, that there is a sideways market, once again with this upward direction. So the direction of the moving average can help us to confirm the trend. Another way that these moving averages can be used when it comes to direction is by having two moving averages on our charts. Okay, and there's a very choppy market. We'll come back to that one. Let's come to this one and get rid of this fast moving average. I don't use MetaTrader as much as I used to. There we go. Okay, so you can have two moving averages. As I mentioned earlier, a faster and a slower. A faster and a slower. The slower is the red, faster is the green. So we have a 100 moving average, which is red, and a 50, which is dark green. Now, when the red is above the green, when the slower moving average is above the faster moving average, that can indicate a downtrend. You can see that's the case here. So the red is above the green. When the green is above the red, that can indicate an uptrend. You can see that we have that here. If we go back and see other trends, like look at this very clear uptrend here. The faster is above the slower, the red is below the green is above the red. It confirms an uptrend. So that's how they can be used for market direction. They can also be used for market momentum. That's not something on my list, but we'll just talk about that briefly now. The space between the two moving averages can usually indicate the momentum. So with this downtrend here, the red is above the green, and we have a nice amount of space. As this space gets tighter, you can see the downtrend, the strength of the downtrend actually dies out. So it can signal like the end of the trend. That's kind of moving on to my next point, is a change in market direction. But a good amount of space between the moving averages can signal the current direction is going to continue. But as these moving averages get tighter, that can suggest that the direction is changing. Okay. Any questions? Use the comment section below. So change in market direction. I kind of touched on that, but let's go back to my chart. So a change in market direction. As mentioned, as these moving averages get tighter, that can signal a change in market direction. But it's this crossover that is the significant thing I want to highlight at this point in the video, is when these moving averages cross, that can signal, that can confirm the end of a trend and the start of a new one. So we have an uptrend here. The faster is above the slower, the green is above the red. They cross over here, so the red moves above the green, the slower is above the faster. So we have an uptrend becoming a downtrend. Look at that. Let's find some more. So same sort of thing here, downtrend, red above the green. They get tighter and tighter, they cross over. Let's move to a different chart. US dollar, Swiss franc. So you can see here we have an uptrend. It's a nice amount of space between the moving averages, but they get very tight now, and they could cross over. So this could be a change in market direction. Perhaps the end of this uptrend and the start of a downtrend. Or the end of the uptrend and the start of a consolidation. And let's move on to that now. So going back to this chart here where things got very messy. If these moving averages are crossing frequently, like they are here, that can suggest that price is consolidating, that it's choppy, that price is moving sideways. So, nice space, moving up or moving down can confirm, can signal uptrends and downtrends. They're moving sideways, they're crossing frequently, that can suggest consolidation and choppiness, a sideways market. Let's find a better example. Euro, US dollar. Look at this. Cross, almost across, cross, cross, cross. And price isn't really going anywhere. It's very choppy. It's moving sideways. Okay, time for a drink. Time to check my US dollar Canadian dollar position. It's not looking good. Okay. Back to the slide. So that's how moving averages can confirm a change in market direction as well as market direction. Now, moving averages can also be used for support and resistance. This is another reason why you need to know the basics of price action and technical analysis before watching this video, because you need to know what support and resistance is. Moving averages can act as support and resistance just like horizontal levels can and diagonal levels can. When a moving average acts as support and resistance, it can be called dynamic support and resistance. So dynamic support and resistance. That's the end of the slide, but let's have a look at some dynamic support and resistance. Let's use our trading view this time. So if we look at, say, a trend, let's find a nice trend. It's very choppy, isn't it? I don't know why I chose Australian dollar, Canadian dollar. Let's have a look at, say, Canadian dollar, Swiss franc. Let's see what's happening here. So, if we look at this downtrend here, the moving averages don't just cross bearish and signal the downtrend. They also act as support and resistance. So you can see that when price nears these moving averages, this is a 150, price can reverse at these moving averages or in between them. So here we go. Not going to happen every time, but they can act as support and resistance. Not the best example. Sometimes though, it works very well. We have a nice clear sideways market here. Let's go back to that trend on Canadian dollar Swiss franc. So this is a perfect example here. Support at the moving averages. Support at the moving averages or the 50 SMA. Support at the 50 SMA. Support at the 50 SMA. Support at the 100 SMA. Support at the 50 SMA. Support at the 50 SMA. Price then breaks, starts downtrending. Resistance at the 50 SMA. Resistance at the 100 SMA. So dynamic support and resistance. Like I said, not going to happen 100% of the time. If you have a nice trend, nice clear trend, I'm in euro pound at the moment. Look at this, resistance. Resistance. Okay, so once price is downtrending or uptrending, you can see these reversals. These reversals happen at these moving averages, these key moving averages, the 50, the 100, the 200, the 7, 14 and 21. Okay, that brings us to the end of this video. If it's been helpful, please let me know below. Any questions, use the comment section below. I'll speak to you in another video. Take care and best of luck when it comes to trading.